to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. It's been an interesting week in the stock market. Some observations I've been making. I don't know if many of you know, but I run a small fund, and it's very small. In addition to managing client accounts on an individual basis and watching the things that are going on inside the market that generally don't get reported on by the regular news. Very fascinating. And if you hang around, latter part of today's show, I guess probably the last 15 minutes or so, I'll get into some specifics on that. But what I am seeing right now is that there are certain sectors that are just blistering the other sectors of the stock market. I mean, the outperformance levels haven't been this high. I can't even remember how long it's been. It's been an incredibly long time period. And a lot of your momentum-based models have come back when, I'll tell you, the past 2.5, almost 3 years, momentum has not done well. And those types of funds and those types of strategies have really come back in a big way just in the last couple of months. And that's kind of a big deal. How long is that going to last? Nobody really knows. But I can tell you that the economic conditions do favor an extended time period of outperformance for those strategies. Now, what am I talking about? Well, I'm talking about the fact that the revenue on the S&P 500 has been the highest increase. Well, it's had the highest increase year over year that it's had in several years. Actually, I think it's going back 8 or 9 years now. That's a big deal. You keep hearing about, this is the longest bull market and it's going to correct. No, it's not. I've been around quite a while, and I'm pretty sure that it's not going to crash anytime soon. A 10 or 15% drop is unavoidable. That's like winter. But a big crash, barring some political thing that might happen, there's nothing in the economy that would cause that to happen. Not yet anyway. And valuations are not that high relative to their long-term averages. And if you take out the biggest 100 companies out of the S&P 500, there's an awful lot of stock in there that's undervalued from a bunch of different companies. So that's pretty good. Emerging markets international starting to come back to life this year. 5 years of horrible performance. And this year, they're two of the leading categories. So there is a lot of opportunity now. Now's not the time to be afraid. Now's the time to spread it out a little bit. You want to take advantage of some of the emerging markets. There's some things that you can do. We'll be talking more about those specifically on future shows. I don't want to spill the beans yet, but there are some things that you can do at home. Take advantage of this. I'm going to build a model for it for people who are really aggressive and want to try to take advantage of what's going on in there right now. But so stay tuned and keep staying tuned. We're going to do a lot of other things this coming year. I'm moving my office about a mile away, and the space that we're going to be in is going to have space for doing meetings on a smaller basis, because there's a lot of stuff that I want to cover in this show and going forward. And I guess for a lot of people that have been with me for a long time, it's kind of going back to basics. But there are some changes. Markets evolve over time, and that's kind of important that you keep up with that. I think the opportunities today are pretty good. And actually, they've been a lot better than I've seen in several years. People are going, "What do you mean? The market's been going up?" Yeah, no. The large cap stocks have been going up. A lot of other stocks have not participated nearly to the extent that the top 50 stocks in the S&P 500 have. And the S&P 100, look at that. Look how well that's done. That's crazy over how well that's outperformed many other indexes around the world. So if you've got a well-diversified portfolio and it hasn't been keeping up, my suggestion is don't worry about it. Maybe you want to get a look at it. Make sure you're still in those areas that haven't participated quite as much because they're starting to outperform now. And going into those funds that have just outperformed over the past 4 or 5 years, bad idea that the stocks are overpriced there a little bit. Not hugely, nothing like the year 2000, but there's a small overvaluation there. And in the long run, the more undervalued the stock is, the better it has a tendency to do. Pretty simple. So I think your day is coming. I think the investment performance across all types of portfolios is probably going to improve because so far it's been concentrated into the really big names that you recognize. There are 3,000 stocks out there that are publicly traded just in the United States that are over $250 million in market value. 3,000. How many can you name? And this is that's my point. There are a lot of stocks and they're moving. They're starting to move. That's a good thing. I've been waiting a while for this. Patiently, sometimes impatiently, but there's not much you can do about what the market decides to do collectively. What's the backdrop behind all this? The backdrop is really good. You've got an economy that's growing. You've got inflation that's relatively stable. It's not increasing at 4, 5, 6%, which would be very tough on stocks and bonds together. So that's good. It doesn't look like we're headed that direction anytime real soon. Maybe the Fed raises interest rates. Maybe the long-term Treasury gets to 3% or so. I doubt that it goes much higher than that. But those aren't my calculations. I just I read a lot, and I read a lot of economic forecasts and read a lot from the Fed. It's amazing. You can go to the Fed's website and they'll tell you anything you want to know. Everything you ever want to know about the Fed and more is right on their website. They give you their opinion on the economy. You can download the Blue Book. The Blue Book is a report by the Fed. Back when I was in college, I went to Kent State, and Kent had a huge library, and they had a lot of resources there for some reason that other schools didn't have. We used to get a lot of visiting professors coming in to use our library on economic data. And so I was kind of spoiled there because I had access to it. Just all I had to do is walk over to the library, and kind of neat. Well, now all anybody has to do is get online, and we all have access to that information all the time. It is kind of hard to read. A lot of it's hard to understand, but if you do it long enough and keep your dictionary of financial and accounting terms with you, or actually just Investopedia now, read that stuff, and sooner or later, a lot of it will start to make more sense to you. And then you'll realize why they call economics the dismal science. It's very difficult to make forecasts that are really good. And in fact, they have to make forecasts because people expect it. But if things change, they will change their forecasts. And a lot of people get mad at them for that. No, that's kind of what you have to do. And right now, their forecasts are pretty good. I don't think the new Fed chairman, whoever that's going to be eventually, is going to stray too far from the playbook that they've been on. And that's a good thing. Housing starts. Boy, those numbers came out this week. They were blistering. They haven't been moving that fast since 2005, 2006. And I can tell you, the lending environment today is a lot different than it was in 2005 and 2006. You've got to have a real job to get a loan. That's different. They're going to verify that you have a job, and they're going to verify income. That was part of the problem back in 2005, 2006. There were a lot of loans that were being made. They were called no verification loans. That means they were just taking people's word for it. Oh yeah, I make $3,000 a week. Okay. Yeah. So a lot of things that are different about this market. That's a great thing. By the way, I haven't really decided. I'll come out next week with a seminar. We're going to do one probably the second week or the first week in January. I haven't decided what I wanted to cover yet, And I am going to be covering some of the stuff that I'm doing with Telechart and some of the stuff that I'm doing with the small fund, because I think it's time. Everything is kind of cyclical. A lot of the strategies that I use, they're cyclical. Your value-oriented strategies, those can be very cyclical. The almost any investment strategy is going to have some cyclicality to it. And I think the time is actually here now for the more momentum-based. The thing that I really like about that is a lot of the stocks that are moving very quickly have good valuations. That's an important thing. If the valuations are relatively low and the stocks start moving, they tend to move a lot farther than they do if the valuations are already very high. And that makes sense, right? It's common sense. So that's going to be an important thing going forward. We'll actually, every seminar now, I'm going to talk about a website that we put up for all of our clients. You're able to track your expenses, all your expenses. You're able to track your investments. We automatically upload the investments that we are managing for people, so you can keep your eye on that. It's a great tool. It's available to any clients. We've been sending out invitations, and I have a feeling that it's ending up in people's spam mailbox because not many people are responding. And maybe they just don't want to. That's okay too. That's kind of how we work at Bullington Capital. We can do an awful lot of things for you, but only if you want us to. So we don't try to make anybody do anything that they don't want to do. And I feel pretty strongly about that. Yeah, but we make available some tools that are just, they are just so helpful. And I really find the tracking tool, tracking the spending tool, phenomenal, because it goes in, downloads the transactions and puts them in one place. So then I can export that to a spreadsheet. Most people just use the portal, the financial portal that we provide to take a look at that. But I like to export it to a spreadsheet because I like to play with the numbers myself. I like to see, get a little bit more detail into it, and it just makes it so much simpler to do it that way. You go in, you download all your transactions to a spreadsheet, and then you can sort, rank, kind of take a look at it, tear the numbers apart if you'd like. And to me, that's just a lot easier. But everybody's different. That's one thing that I've really come to realize a long time ago. Everybody's different. In fact, your investment strategies, the ones that you're using or your advisor's using, everybody's going to have a little bit of a different take on stocks, investing, and trying to come up with a model, an investment model that you can follow that kind of suits you, that kind of matches your personality. That is not an easy thing to do. First of all, you have to know the difference between them. And then you've got to find those that kind of match your thinking when it comes to investing. You see, it's a lot easier to stick to something when the markets are down, when you're doing something that you know you're comfortable with. There's been a bunch of research just over the past 10 years on financial behavior of investors and people and governments. And what they've come to find out is that everyone, including governments and people that are supposed to know better, end up being emotional, and their emotions take control at some point in time. In many of the cases, not always, but in many cases, emotions take over, and that leads to really wild swings in financial markets. Basically what it is, it's all emotional. And so finding some strategies or hiring somebody to find them for you, to sit down and talk with you, to figure out what kind of strategies would work best for you, that's kind of a key. And I find it kind of interesting too. When I am sitting down and I'm talking with somebody, I find it interesting that they resist answering any questions. And I'm like, okay, well now I have to guess, And that's a lot like going to a doctor and saying, "Hey, fix me, doc. I feel sick." Well, what's wrong with you? I don't want to tell you. Just fix me. Okay. It's very difficult to do, but someone will give it a try. And so you kind of have to do that. What are your expectations? what are you comfortable with? Do you know how to value a stock? That's kind of a key. If you're going to do, and in fact, this will be part of the topic that we cover at the workshop. I haven't set the date up yet, by the way. Beginning of January. Doing a little bit of research. Now, I know some people don't want to do any research whatsoever. They have no interest in learning how people manage money, which I find fascinating, because the only thing I think might be worse than dying young is being broke. I don't know, a lot of people probably don't agree with that. Oh, you're just all about money. No, I'm not. I'm just realistic. You have to have money to be able to live, to be able to pay your bills, to eat, have food. It's an important topic. It's a very important topic. And a lot of people just didn't want to know anything about it. That is crazy in my mind. And I know why, to a large extent anyway. In many cases, the industry itself has made this so difficult. They want to make it so difficult that you basically just have to trust whoever it is you're talking to that's confusing you. And I'm really not a big fan of that. I really like to try to explain things in a simple fashion, and it can be done. It can absolutely be done. In fact, that's one of the other things we'll talk about at the workshop. Earnings yield. I'm going to start using that language in my show from this point forward. Earnings yield. What is that? It's a phrase. I've used it for a very long time period. I just read an article recently where Warren Buffett was using the same phrase. I'm like, oh, great. Why didn't you use that 20 years ago? I think people would have understood a lot better if you said earnings yield. What is earnings yield? Basically, you take the profits that a company's earned over the past 12 months, you divide it by the share price. It gives you a yield that you can compare to a CD. It's that simple. It's that simple. It's actually the opposite of a price to earnings ratio. Price to earnings ratio is confusing. Nobody knows what it is or whether it's any good. I don't mean nobody. A lot of people know what it is. But a lot of people that are young, they don't know what it is. And I think it just confuses people. If you say earnings yield, what's the earnings yield on XYZ stock? Oh, it's 5%. Oh, great. Maybe we should look further into that. Now that I hear the music, I have to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned, because when we come back, we're going to give you more of the answers. And we're back. Hey, if you have a phone call, question, or comment, 216-901-0945, 216-901-0945, and feel free to give us a buzz. Hey, the last 15 minutes, we're going to talk about the individual stocks. I used to talk about that quite a bit, and so I've got a lot of requests, people coming and say, hey, let's just talk about that stuff some more. Okay. You make the wish, you make the request, and I'll try to fill it if I can. And I think this is a good time to be looking at the stock market. I know people are talking about how far it's gone and this. Yeah, but it was down 50%. I mean, come on. It's not really up to all that much from its former high. And it's been a lot of years since that time period. So, it's actually right about where it should be if things were normal. And I'm telling you, things are actually better than normal. The growth rate has picked up a little bit, so that's a really good thing. When you have normal valuations and you have, and actually, even if they're slightly above normal in the large cap stocks, which they are, okay? Large cap stocks are slightly above normal. That's not a big deal. Your biggest moves have a tendency to come with conditions just like that. And I think this has the chance to be one of the longest bull markets in the history of the country. But that's because the recovery was so slow. Think about that for a second. If it takes a long time, if you're recovering, but you're recovering at a very slow pace, yeah, it's probably going to take longer. It's not rocket science. It's going to be longer. And I think this is probably going to be one of the longest in the history of the country, mainly because it was so slow in the early recovery process. The first 8 or 9 years, that's a long time. Heck, when I was in college, they taught us that the economic cycle was 36 months. Now, 3 years, boom and a bust, boom and a bust. And I still went into this business. But you know what? Yeah, because if you look around, and particularly today, if you look around, where is the money in the world going to go? You're going to go into a CD at current interest rates, even if CDs were paying 3%. There are a lot of people that would take a 3% CD, by the way, and just lock it away because they just don't know any better. And they're clinging to security, and that's fine. They don't know any better. But I'm here to tell you the stock market is not so overpriced that you should be avoiding it. If you're looking at putting money into the market now because maybe you're retiring soon, or you have inherited money, or you've changed jobs, now you got to change your 401k plan. Now is a great time to be running a balanced account. I don't think anybody ever needs to be 100% in stock unless you're really, really young and you're adding to it like all the time. Then you don't need to be doing that. A 70-30 split is probably as aggressive as you should be, at least in my opinion. That means you can have 70% in stocks, 30% in short-term fixed income, bonds, bond funds, ETFs, and then get ready to rebalance the portfolio. When the stocks go down, you don't take money out of it. You wait, and then you add to it. I was going to say a couple different things there, actually at once, but you wait and then you add to it. Okay, it's particularly today. Valuations aren't that high. The banking system's in pretty good shape. You don't have a whole lot of home loan delinquencies anymore. You've got some car note delinquencies, and they're at one of the higher levels. So, and that's going to act like a regulator on the economy. People are borrowing, $50,000, $60,000, $70,000. That the new Tesla is $250,000. They're borrowing a lot of money on their cars. Some people have bigger car loans than they do mortgages. Actually, a lot of people do. So that's going to act as a regulator. It'll keep the economy from getting too overheated. People are actually saving, I guess it's right around long-term averages, which are not bad because they were below average for an extremely long time period. And you look at the net per capita. That's the per capita per person. It's at one of the highest levels it's ever been in this country. So the assets to debt, it's one of the better ratios. It's in better shape than it's been in years and years and years. That's a good thing. The government, you keep hearing about the debt. Well, the debt's big because the economy is big. But when you look at the debt in relation to the economy, it's not that bad. It really isn't. But you know what? That doesn't sell ads. Somebody says, hey, come on, don't worry about it. We're in good shape. After World War II, we were 145% debt to GDP. And people go, yeah, but that was after World War II. Yeah, there were not anywhere near as many jobs then because a lot of the industries that we've come to rely on today didn't even exist. We have a lot more jobs today than we did then. A lot more. In fact, we've got so many jobs, we can't even fill them now. That's why you're not hearing about the wall that much. We have a hard time filling the jobs that are going unfilled here now. Putting up a wall would actually curtail that fairly significantly. So kind of a big deal. In other words, things are actually pretty good. Actually very good. And if you get a 10 or 15% correction here, not to be too excited about. I'd have some money. I always have money in short-term bonds in every portfolio I manage, even my own. I've got money able to go and buy more stocks, at least to get myself up to that long-term level where I think I should be. Now that's going to be dependent on you, your financial situation. There are a lot of variables in that. You can't just make a blanket statement like that. I know it would be a lot easier if you could, but that's called a heuristic, by the way. Heuristic is a simplified idea that somebody can adopt to tell them what to do in a specific situation. Now, that would be great if you could do that in financial markets. Unfortunately, it doesn't work that well in the long run doing that. So this is something you actually have to give a little thought about. Hey, by the way, I'm going through the scan from yesterday. This is kind of the first time I've looked at it. And there are trends. I mean, these trends are just jumping out of the screens. And so I'm going to tease you with that because that's coming up in the last part of the section, of this show. And there's some really good names and good valuations. This is crazy. Some of them are extremely surprising, I guess, really surprising. And I like it. I think we might. Oh, the other thing that you should probably know, this time of year in the last 4 or 5 years has been phenomenal. It's been where a large percentage of the market's gains for the entire year actually happened. So, and the reason I'm saying that is I've gotten several calls, people going, I think the market's going to crash and it's been up for so long. Hey, you know what? We've got a ton of money in short-term cash. If you get a big drop, I think we should actually buy into that. First of all, you can't predict that anyway. And that's another thing. Trying to predict when the market's going to make another, that is the most dangerous thing you can do to yourself financially. You really need to figure out how much of a risk taker you are to begin with, allocate your portfolio correctly based on that, and then rebalance when you get those opportunities to buy stocks at lower prices. That's the way that this really should be done. That's the right way to do it. And in the long run, if you were doing that, if you're carrying stocks, bonds, and cash, whether it's mutual funds or ETFs, doesn't matter, or the individual securities portfolios, if you're always expecting a correction, when the correction happens, you're expecting it so you know what to do and you can respond appropriately. That's called investing. Anything else is, you're making it really hard on yourself. See, one of the really tough things about being able to get out of the market and avoid one of those corrections is when to get back in. You got to be right twice in a row. You got to call the drop, and then you got to call the recovery. And that's why the average investor just doesn't do very well. The average investor doesn't do very well at all. There's a company called Dalbar. I'm not even sure what that stands for. But they study investor behavior. That's all they do. They've been publishing these results for years and years and years. You should look them up. Look up and see what the average investor does. And I can tell you exactly why. They keep trying to forecast what's going to happen. And they make these moves based on these forecasts. And when it doesn't work out like they didn't think it would, emotionally they become a wreck. They start guessing, and one bad decision leads to several others. And that's the typical thing. And it's very difficult to control your emotions. And I think investing is 95% emotional. 5% knowing what to do. 95% actually doing it. That's because it can be hard. It can be very hard. I'm reminded of that every day because I look at this every day. In fact, I've been getting up earlier than I've ever gotten up in my life because I've gotten to the point now where if I don't get in the office a couple of hours minimally, couple of hours before the market opens, actually a couple of hours before 8:30, and don't be calling me, by the way. I'm not going to answer the phone. I know the minute I say that, somebody goes, aha, I know when to call them. Nope. You call before 8 o'clock, I'm not answering. I get there at 6. I'm getting there at 6. I get that first 2 hours. Those are my hours. I'm just playing. But so 6 to 8, and I'm doing the scans, looking up the stocks, and this is how I see what's going on in the marketplace. This is how I know which stocks are moving, which sectors are doing well. And it is fascinating. And and I really like doing this, by the way. I really love doing that. And if you do call before 8 o'clock, I really won't answer the phone, but I'll answer it later, and I'll get to it that day as fast as I possibly can. And that's pretty good. When we get over to our new office space, I decided that we would start to meet. They have some meeting facilities there, a little informal. And once a month, we're going to get together because I love doing this. This is a blast. This is why I don't have a lot of hobbies. This is my hobby. I'm fortunate enough to be able to do it for a living. How cool is that? Yeah, nice to be in America. So I really enjoy it, and I'm really going to enjoy being able to get together with people. And you know what? I am working on something. I don't know if I'll be able to do it yet. But I can't do what I'm talking about, what I'll be talking about in the last section of today's show. I can't really do that for individual investors. I haven't been able to do that for a long time because the infrastructure from the brokerage firms was not there. So that's why I actually started that little fund. But I may be able to do this for individual investors. I will definitely be able to put up a course, and we're definitely going to form what basically amounts to a support group. Investors Anonymous. That's what it's going to be. Because it has to be. I mean, when you see the level of psychological energy that this takes, it's not intellectual. You do not have to be good at math to be a good investor. That should make you guys feel a lot better. You don't have to be a math genius. It doesn't help at all. In fact, it could be a big hindrance. Okay. So what you do need is you need to constantly work on your own mind to put yourself in the mode of being a successful long-term investor. And I think that's it. Learning what to do. I can teach anybody. And I have people ask me this all the time. Could I learn to do this? The answer is yes. You could also learn to fly a plane. You could probably learn to do surgery if you've got a really good memory and want to go to medical school. The answer is yes. I believe anybody can learn how to do anything. It's whether or not you're going to want to do it. And when the going gets tough, who do you rely on? How do you pick yourself back up? It's one of the reasons I have a job. And believe me, I have to pick myself back up all the time. And I had a guy asking me, a client's been with me forever. He goes, you still struggle with that? I go, listen, dude, everybody is going to still struggle with that. That's nowhere near as difficult as it was when I first started. But hey, market goes through a 2 or 3 year time period where what you're doing is not very productive. Yeah, you're going to struggle with that. No doubt. And thankfully I can tell you that stocks are moving. The types of stocks are moving that I like to see moving. There are good fundamental reasons for these stocks to be moving. That's a big deal to me. That's what makes me feel comfortable. When I see a stock that's going up that should be going up, I feel better. When I see a stock that's going up only because I know it's rumors and speculation, wow, that's tough. I can still buy those stocks and I can be profitable doing it as long as I keep my positions small enough and keep my emotions way out of that. But having emotions like every other normal human being, when they start to creep in, it feels better to me to buy something that's undervalued and going up fast. Call me crazy, but I like the ones that are undervalued and that are moving up. This is like we haven't seen a scenario like this for a very long time. Now, will I be able to capitalize on it? I hope so. You never know, but I can tell you that all the stocks that I'm talking about, incidentally, are part of the ETFs that I have in the models. And this particular style of investing that I'm talking about, soon we're getting ready to go to commercial break. When I come back, I'm going to actually give you some actual names. This style of investing, you should not be doing this with more than 10 to 20% of your money. You shouldn't, because you don't have time. Secondly, it's more aggressive than the other ones. It's not something that you can set and forget. So having said that and hearing the music, that means I have to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. We'll be talking about some individual stocks when we come back. And we're back. This is going to be my favorite section of the program going forward. I'm going to talk about individual stocks, and I'm going to look up the number of stocks, tell you basically what I'm doing. I'm working on there's a thing with interactive brokers. I may be able to, and I hate to, I really hate saying something like this because I don't know yet whether I'll be able to provide this for the general public. I'm working on it though. I would really like to do this. Most people that have been with me for a very long time know that I used to use this particular style of investment management that we will be talking about at the next seminar. It's aggressive, but it's intelligent. It's intelligently aggressive. That's the thing. And I like doing it. I love doing it. It's awesome. And I wish I could do it on a much wider scale. And I may be able to. I used to. I may be able to bring that back. So I'm working on it, and I just want to let you know. But even if I don't, and I like sharing it with other people because it's super logical. I mean, it is super logical. In fact, I'll tell you what it is. I'm looking at the stocks that are going up the fastest right now. If you want to make money sooner than later in the stock market, doesn't that make sense? Wouldn't you like to go see which stocks are moving up right now? Yeah, and kind of common sense, right? I tell you, you do not have to be a rocket scientist to do this stuff. I might be putting myself out of a job here. I'm just kidding. Anyway, you go to those stocks that are moving up right now. Now, not just any old stock. Okay? They got to be going up fast right now, and you'd like to see that there's some sign that they're still under accumulation. So that's one of two things. The stock's either making a new 1 month high, so that means it's still, it's making a highest price in the past month, which is a sign that, it's still under accumulation. What's the most bullish thing a stock can do is go up, right? That's the most bullish thing you can do. So it's either making a 1 month new high, or the share price is up more than 3% in a day. If the share price is up 3% in a day, that means somebody's buying it. 3% in 1 day is a fairly big move for a stock. Okay. So it's already in the leader category. It's in the top 10% of all stocks. And it's up more than 3% in a day or has made a new 1 month high. Now, when I get to that list, I want to eliminate all those stocks that have valuations that are so high that if some little piece of bad news comes out, it's going to come crashing down like 70 or 80% overnight or in an hour. I want to eliminate those. So I'm going to use a thing called the price to sales ratio. I'll explain all this at the next seminar, and there's going to be a course on this too. Yeah. So once I've got that list, then I get to go down and I get to start looking at the stocks. And these are the stocks that are under accumulation, at least currently, by institutions. Typically, it's institutional buyers that are pushing these stocks up. And all I'm doing is trying to identify which stocks are going up and why. Why are they going up? I can tell you right now that the why, in many cases, you won't be able to figure out. I can see when a stock is potentially undervalued. That's pretty easy to do. Again, we'll cover that at the next workshop. And but I can't tell you exactly why it's being recognized right now. Why do they just decide to start paying attention to it now? I have no idea, nor do I care, because my number one goal is to try to make money. The number two goal is to try to preserve assets by minimizing my losses when they decide to sell the stock and it starts going the other way. So those are the two top priorities. Try to make money, try to minimize your losses. In fact, a lot of people just focus on minimizing their losses, which is good too, and then putting themselves in a position to make some money. And here's what I've been seeing. The past 2 weeks, retail stocks are flying. Retail stocks it's unreal how many of them are coming up on scans. And their valuations are incredibly low. These stocks could move 300 or 400% just to get back to normal. Think about that for a second. Would you rather have a stock that's overpriced by 50% or one that's underpriced by 75%? Yep, not a trick question. That's what you want to look for. And I'm so excited about it because it's been so long since I've seen this many stocks moving like this that have good reasons to be moving. I see a lot of stocks that are moving over the past few years that don't have good reasons to be moving. And man, that is tough. That is a lot harder. if you've ever tried to do this sort of thing, you'll notice that those stocks tend to be a lot more volatile. If they're moving up fast, but they don't really have a good reason to move up fast, other than people just keep buying it, it makes it incredibly difficult to make money with those stocks because they're, somebody will sell a big position, the stock will drop 15 or 20%, it'll stop and then start going back up again. Those are hard. Those are incredibly difficult. So I wouldn't recommend that as a style, although I have seen people that have done very well that way. They got super thick skin. And they don't mind underperforming for, 4 or 5 years by a lot. I have a strategy that's actually kind of similar to that. I run it through a folio, and it's done very well. In the past, for 2.5 years there, it was not doing very well. It was underperforming. The first 2.5 years I brought it out was doing great. And then recently, over the past 12 months or so, it's done very, very, very well. And I had to remove it from a lot of portfolios because of Department of Labor rules that they have since suspended. That really makes me mad. These guys, anyway, that's a long story. But going down through the list, I'm looking at the list right now, and I must have done something incorrect here because it looks like there's 145 names. I don't think that should be right. No, that's probably not right. I'm going to do something right now. I'm going to copy to a new personal watch list. By the way, I'm doing this live in the studio. So this is about how long it takes when you've got the software all set up on your trusty telechart. I just ran the scan. I put one of the lists in there. There are 3 lists that you're going to take from. And I'm copying all the symbols right now to that new list. And the one that I just put up there. And I've got here's the third one. This is a 6 months high relative strength up 3% in a day. This is the one I'm copying to now. And there, I just got all them done. Now I'm going to open that scan right before your very ears on the, and there it is. And there are 61 names. 61 names. These are companies that have met a certain set of criteria that tells me that they are under accumulation by typically big mutual funds. And I'm going down this list, and I got to tell you, looks like Black Friday. This is crazy. You've got a Kroger's grocery store chain coming up on a momentum scan. That's kind of funny. Genesco, do you know who they are? Johnston & Murphy. They make all that stuff. Retail stores, shoes, belts, clothes, that stuff. Express, you know who they are, right? Limited, all that kind of stuff. All the trouble they've been having. Abercrombie and Fitch, that comes up. Hibbert Sporting Goods, that one, man, that one gapped up on huge volume. Shoe Carnival, these are all coming up the same day, by the way. This is what I'm talking about. One of the things I'm talking about. When you see lots of companies in the same industry coming up at the same time, and I'm not done yet. I mean, there's still a ton of other ones there. G3 Apparel. There's I'm just going Foot Locker, DSW Shoe Store, Guess, Tilly's, Party City, which is really funny. One that I already own is American Eagle Outfitters. The Gap came up. Urban Outfitters, Buckle. All these stocks have relatively low valuations and are coming up on momentum scans. What this is telling me is that there are big funds that are called sector rotators. If they like a sector, if they think a sector is going to do very well, they'll actually come in and run the share prices up ahead of the news. So evidently, they are anticipating that this is going to be a very good Christmas, which they should, because personal incomes are up at the highest levels they've ever been in an extremely long time period. What do people do when they've got jobs and money in their pockets? Yeah, they tend to spend. So if you waited until after the Christmas season to see what the numbers were, probably going to be too late. At that point in time, the move may be over. And as fast as stocks move today, I mean, stocks are more volatile, both up and down. Okay, so key portion of that or component of that statement was both up and down. By the time the numbers actually come out, these things will be up probably 50, 60, 70%, if they follow through on the current course. The same way that home builders, I was watching home builders over the past couple of months. They keep popping up. And I'm looking at this and going, home builders, oh man, they're not super cheap relative to their long-term valuations. They're still a little bit lower than a lot lower than where they peaked out at 2006 and 2007. But the valuations are pretty good. And these housing stocks are moving very fast. And then it was just this week, 5, 6, 7 weeks after I saw these housing stocks pulling up on the momentum scans, where the housing starts jumped up 13% year over year. Woohoo! By then, the stocks had already moved. That's why it's important for you to understand what a good valuation level is and to identify these things with price movement. I've spent more than half today's show talking about this. It's because I'm excited about it because momentum is actually kicking in really nicely. And the momentum model that I run, it's doing very well this year. It's going to have a great year. This is the time of year where you really want to pay attention to that stuff. If you have any questions on this, you'd like to get together to talk about it, give me a call or go to my website. The website is bullingtoncapital.com. Now they hear the music, that means today's show is over. So, hey, just go to that website, click on the Contact Us form. I'll get back to you. Other than that, you all have a good week. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Good investing and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.